Welcome to Key Points for May. Now this month we look at what are the prospects for a V-shaped economic recovery, what are the consequences and the implications of the profound policy stimulus that we've seen, and what are investors making of this, the liquidity versus the deteriorating fundamentals. Now to our first point, you're all aware and feel this slide into recession, and indeed Q1 data have shown that there was a contraction in the first quarter of most of the major economies. But of course it's this current quarter, the second quarter, that we're likely to see the greatest damage of the lockdowns, and indeed numbers are going to be posted that we probably haven't seen since the 1930s and the time of the Great Depression. Now we are expecting a recovery thereafter, but if you think about the V's, the bottom of that V is being pulled lower. And for our own forecast for 2020, we now expect the contraction to be in the order of 2% of global output, before then recovering in 2021. But even by the end of 2021, activity levels will be about 3% lower than they otherwise would have been. In financial terms, that is really losing $2.5 trillion, or to help visualize that, that's basically the size of the Indian economy that is being given up and will not be recouped. But of course, it's ultimately what the virus does in the coming weeks and whether that lockdown can be eased that will determine that economic trajectory. Now, turning to our second point, of course, one of the reasons that we're expecting this pickup and recovery is because of the profound policy response. Lessons were learned from the financial crisis, and indeed the monetary policy support is vast. Roughly $5 trillion of asset purchases are being committed to by the Bank of Japan, the ECB, and of course the Federal Reserve, amongst others. And from a fiscal perspective, of course, we're seeing very large scale commitments there too. In the case of the United States, about 13% plus of GDP is being used to bolster this ailing economy. And again, we think that will ultimately lead to recovery going forward. Of course, this will leave us with higher debt levels at the government, at the corporate and the household level going forward. But again, that's something we'll have to worry about perhaps in the months, quarters, years ahead, rather than too much today, because this support is required. Now, turning to the financial markets, we had said last month that we thought liquidity could continue to drive asset prices higher. Indeed, April turned out to be one of the best months for equities really since 1987, and credit markets have also done well. Now that liquidity that we're expecting to continue to be applied throughout this year, we think will drive markets higher, but we are expecting a bit of a period of consolidation, a bit of a pullback before we get that next leg up. And of course, the credit markets are going to do, I think, well as a result of this Fed and others taking on direct credit onto their balance sheets. So remember, you can read this full report along with all our other papers and topical papers, as always, on zurich.com/MSME.